For decades, we've been taught to see the economy as this big, cold machine, a place where everything is driven by hard calculations and pure logic. But what if that's only half the story? What if the market actually has feelings of its own? Let's dig in. For the longest time, economic models were all built around this one perfect character, Homo Economicus. Think of this guy as the superhero of economics. He's always perfectly logical, he never gives in to temptation, and he's basically a supercomputer when it comes to making choices. In his world, every single decision is a flawless calculation. So, what happens when you fill up an entire market with millions of these perfectly rational beings? Well, you get something called the efficient market hypothesis. The theory is pretty neat. It says that the prices of things, stocks, bonds, your house, always reflect every single piece of available information. Prices are always correct, and the market becomes this beautiful, self-healing system.
It's a really clean theory, right? But it smacks right into one very big, very messy problem: reality. If markets are supposed to be so logical, why do they feel so emotional? Why do we see these huge, gut-wrenching swings that can totally define a generation?
Just look at this chart of the US economy. This is not a smooth, predictable line heading upward. It's a total roller coaster of boom and bust over and over again. It looks less like a machine, and honestly, a lot more like a heartbeat. Let's just zoom in on a moment we all remember, the 2008 financial crisis. Now, the story we usually hear is that it was all about bad mortgages and weird financial products nobody understood. And yeah, those were definitely part of it, but it turns out that wasn't the whole story. Some fascinating research shows something else was really driving the chaos. In fact, one deep dive into that period found that the main cause wasn't just a technical glitch in the system, it was psychological. It was a sudden, massive, adverse shock to expectations, or in plain English, a collective crisis of confidence. A giant wave of pessimism just washed over everyone and, it became a self-fulfilling prophecy.
Okay, so if it's not the cold, hard math of our friend Homo Economicus that's really in charge here, what is this other powerful, invisible force that can literally bring the global economy to its knees? Well, the answer has been around for a long, long time, and it has a fantastic name: animal spirits. This is the ghost in the machine, the unpredictable, very human element that all those standard models just couldn't account for. The term was made famous by the legendary economist John Maynard Keynes way back in 1936. He argued that most of our big decisions in life aren't about carefully weighing the pros and cons. Instead, they come from a spontaneous urge to action. It's a gut feeling, an instinct to just do something. So let's slap a modern definition on it. Animal spirits are basically the cocktail of emotions, instincts, and biases that shape our economic choices. It's the gut-level confidence that tells an entrepreneur to risk it all on a new business. But it's also the contagious fear that can trigger a market crash. And this slide just nails the difference, doesn't it? Traditional economics gave us econs, who are these rational, optimizing machines. But behavioral economics shows us we're just humans. We're emotional. We often just pick the good enough option instead of the perfect one. Our brains are full of these little biases, which makes us and the economy we build fundamentally unpredictable. Now, I know what you might be thinking. Animal spirit sounds a bit soft, a bit philosophical, but what's incredible is that economists have actually figured out how to put hard numbers to this stuff. They've found a way to measure the real-world impact of our collective feelings. So let's start with a huge one. According to one really detailed study, these belief shocks, these animal spirits, are responsible for about 40% of the volatility in the entire U.S. economy. That is a massive chunk of the booms and busts we all live through.
And if you think that's wild, it gets even more dramatic when we look at investment decisions. When businesses decide whether to build a new factory or hire more people. The same research found that a whopping 2/3, 66% of the swings in investment are driven by these same animal spirits. It's all about spontaneous optimism or pessimism.
Just look at this breakdown. When you ask what makes the market jumpy, our belief shocks, our feelings, are a way more powerful force than the fundamentals like new technology. For investment growth, it's not even a contest. The data is clear. Our collective mood moves markets way more than the hard facts do.
And this isn't just some abstract number from a spreadsheet. The researchers checked their work, and they found that their belief shocks lined up almost perfectly with real-world things we can track, like the U.S. Business Confidence Index. So the model is actually capturing how people are genuinely feeling about the economy's future. Okay, so this is all really fascinating, but let's get down to it. What does this actually mean for us, for our own money? How are you supposed to invest in a world that's driven just as much by emotion as it is by logic? Here's a really important myth to bust. A lot of people think that even if we're all a little irrational, the market as a whole will be rational, that the smart money will cancel out the dumb money. But that's not what the evidence shows. The market doesn't have some magic wand to fix our human biases. In fact, a lot of companies get rich by playing to our biases, not by correcting them.
So what are these biases? Behavioral economists have a great name for them: supposedly irrelevant factors. These are things that a perfectly logical econ wouldn't care about, but that we humans care about a ton. Things like how a choice is presented to you, the incredible power of just sticking with the default option, our deep-seated fear of losing money, our instinct to just follow the crowd, and of course, being way too confident in our own skills. These are the little ingredients that make up our animal spirits. And this brings us to what I think is the most crucial insight for anyone trying to invest for the long term. The goal isn't to find some secret formula to outsmart the market's emotions. You can't. The real game is to understand and manage your own emotions. It's all about psychology, not just math. So here's a really simple framework for living in this human world. Step 1. Acknowledge your own biases. You have to be honest with yourself. Are you a thrill seeker who loves risk, or do you tend to panic and sell at the worst possible moment? Step 2. Build systems. Because our gut instincts can be so unreliable, you need to create systems that protect you from yourself. Things like automatic 401k contributions or setting up regular automated investments are so powerful because they take your emotional brain out of the driver's seat. And finally, step 3. Just remember what the market really is. It's a giant mirror reflecting everyone else's hopes, fears, and biases right back at you.
So that leaves us with one final question to think about. Now that you know the economy is powered by these animal spirits, by our collective gut feelings, take a hard look at your own financial choices. Are you making them based on a cool, systematic plan, or are you just getting swept up in the emotions of the herd?